to invest in stocks. So then I found out about options, and I found that options are a much cheaper way or in investing in stocks. So basically, you are borrowing the right to another person's shares for a certain price. So that's a predetermined price between you and the person selling you the option. You also have the right to fully purchase those shares if need be. And I'll explain how all of this works as we continue on. Now, options are derivatives. And what that means is that it gets its value from something else. So when we have that term called stock options, that means that the option gets its value from the stocks. Now, of course, there's other factors that determine the stocks, the option price, and things that affect the option. But for the most part, the option gets its value from stocks. Now, what are options used for? Options are used to predict the direction of a stock. Options were created for hedging purposes to reduce the risk of downside if you invested in a stock. So basically, when you think about options, it's used to offset the downward curve of a stock. So let's say you bought shares. Somebody give me a company that we could.
GameStop.
GameStop, awesome. GameStop has been a really big hit in the past couple months. But yeah, so let's say you've invested in GameStop and you have, let's say, 100 shares of GameStop, and you have done your analysis and you notice that this particular stock is going to go downwards. What you can do is that you can buy a put option, which that is an option that helps you to profit when the stock goes downwards, and you can use that. So let's say, for instance, GameStop is trading at, you bought 100 shares and it's trading at $300. Let's say you predict it's going to go have a downside to it's going to go down $300. If you buy a call option at $300 and you notice that okay it went down to $290, that particular sorry not a call option, a put option. If you notice that put option can actually be used to offset the downward curve of that particular GameStop option. So what is going to happen is that it's going to balance out. So it's going to offset that downward curve of the option. So you can profit from that downward position while the stock is going down. All right. And so here's the meaning of hedging. Hedging is to protect yourself against loss, or is a bet or investment by making balancing or compensating transactions. Now I'll repeat that again. Hedging is to protect oneself against loss on a bet or investment by making balancing or compensating transactions. So like the example I used before, if you invest in an option and your stock is going down, that option could be gaining in price as even though the stock is losing value. So pretty much the stock has plenty of time to increase in value. But what that option can do is that if let's say the GameStop stock is trending down, you can gain money or gain profit from that put option, and you can sell it at a good price. So while GameStop is trading back up, pretty much it's going to be only upside from there, if that makes sense. And guys, feel free to ask questions if it sounds confusing. Because don't worry, we're going to have some examples so you guys can understand. So here are some option trading pros. Options have the ability to increase your income at a much faster rate than owning stocks. So basically, let's say you have 10 shares of GameStop, and it goes up by $10. How much would that be? It'd be $100. It'd be $100. But let's say you can buy an option and purchase 100 shares for that same amount. But now it's going to be called a contract, right? So that contract equals 100 shares. So let's say you have one contract equals 100 shares and goes up by $10, that would be $1,000. So pretty much options, you can have a much greater increase trading options than you can have trading or owning stocks. So you make money trading options whether the stock market is going up or down. So again, if the stock market is going up, you can invest in a call option. If the stock market is going down, you can invest in a put option. And I'm going to explain those terms as we go on. So when trading options, you buy contracts instead of shares. Each contract is equal to 100 shares. So if one contract is equal to 100 shares, how many is two contracts? 200 shares. Yeah, try to say that to a lot of people. So when trading options,
I mean, yes, but they don't really need to. That's a general question.
I'll make sure everybody can feel you guys got it. But yeah, so when trading options, you buy contracts instead of shares. So each contract is equal to 100 shares. Instead of buying one share for $500, you will be able to buy one contract, which is 100 shares, for $500. And again, if anything sounds confusing, please ask questions. Yes, baby. So, which part? As far as how contracts work, so one second. So instead of buying one share, so let's say one share of GameStop for $500, you'll be able to buy one contract that's equal to 100 shares for $500. So think about it. So one contract costs $500. 100 shares or one contract costs $500. So pretty much you can purchase, instead of you having one share that costs $500 a piece, you can have one contract with 100 shares for that same price. So which one is better? One share that costs 500 or 100 shares that cost 500? It's 100 shares that cost 500. So yeah, what sounds better? So instead of buying one share that costs $500, you'll be able to buy one contract, which is 100 shares, and that costs $500. So what is better? One share that costs $500 per share, or one contract, which is 100 shares, that costs $500 altogether? One contract, okay. So there are option trading pros, there are option trading cons. So options are riskier than stocks. Stocks are a lot more stable than options. So pretty much, if a stock, goes downward, you know, um, yeah, pretty much they're going to recover over time. But when you have options, they have an expiration date. So if it goes downhill and it doesn't recover before the expiration date, that option will be rendered useless. So while stocks have that longevity time, options you have the chance of losing most, if not all, of your investment. So they're very much risky. I see some people's faces like, I don't know about options. So if a stock goes down significantly, you have the luxury of time to recover your losses. If an option doesn't recover before its expiration date, you will lose most, if not all, of your money. Again, if you guys have questions, feel free to start me at any time. Yes.
When you have companies or organizations, usually they buy stock. It's usually like people that organizations that invest in retirement, or they use retirement funds to they invest in stock.
Yes, I think I understand what you're trying to say. So pretty much they don't, so they use like stocks and bonds pretty much for like retirement because it's safer. It's a lot more again, it has more value over time, and you have a better chance of increasing that particular position than if you trade in options, because options may expire. So it would not be safely too risky for them to invest your money into options. That would not be a smart move. But yes, investing in stocks, stocks can go down, but they also go back up. Did that answer your question?
Yes, yes, that answers my
Very
question.
good.
Go ahead.
Awesome. So here are some option trading examples. So the first one is a call option. call options are contracts that give you the ability to purchase the right to a stock, but you're not obligated to buy it. You make money as the stock increases. So pretty much, let's say you buy a call option and the call option goes into your favor. You actually have the right to buy that call option at that set price, even if it rises. So let's say GameStop was $50 and it rises to $60. Let's say that call option goes into your favor, which I'll explain as we go on. But pretty much, you have the right to, the person selling you the contract, you have the right to buy those shares for $50 a share rather than paying that market value for $60 a share.
On the call options,
Yeah.
if it expires, you don't purchase.
Mm.
Expiration, are you required to purchase?
No, so
Or you can just decide not to?
you don't have to purchase it. To be truthful, I was actually going to explain that later on, but I'm glad you asked that question. So with options, you can actually not choose to exercise it. When I trade options, I don't exercise it. Most option traders don't exercise that option. Most people just want the value of the option. So pretty much if the option is valuable, you can just sell it and profit from that. Or if you want to own the stock, that's a cheaper way of owning it. So if the option's in your favor, you can pretty much make that profit from buying the option at a lower, buying the stock option at a lower price, or just selling the option and profiting from the value of the option. Did I answer your question? Awesome. So yes, with call options, you make money as the stock goes down. And here is a bull graph over here. So bull is there's a terminology we have in the stock market, bull and bear. So bull means that the stock is rising, or the market is rising higher. So as you can see over here, we see, well, this is a bull market of 5 years apart. So we see 2010, 2015, 2020, we see a consistent upward trend. So of course there are, when you know how to trade options, there's like day traders, people, well, there's time limits, so you can trade within the hour, trade within the day, I won't get too much into that in this presentation. The next presentation, I'll show you how to set up your own platform so you can be able to trade and use some time limits so you can analyze the market properly. But now here is another option term. It's called put options. And put options are contracts. So I'm going to make a correction here. So put options are contracts that give you the ability but not the obligation to sell a stock. So you don't have to buy put options. You have the right to, so it gives you the ability to sell a stock, but you don't have to exercise it. So it's the same as call options. So for instance, you have a put option that falls in your favor. You can choose to exercise that option, and the person who sold you the contract, or pretty much loaned you those shares, has no choice but to sell those shares into the market. So sell those shares to you, and pretty much you can buy it or you can sell it to the market, or you're able to take it and sell it to somebody at a higher price while you buy that market value. So let's say if GameStop is at $50 and goes to $45, you're able to buy it at $45, but you're able to sell your option contract at $50, if that makes sense. I'm so glad you got to do this. So again, you make money as the stock decreases. And here's a bear graph. So when you hear the term bear, that means that the stock market or this particular stock is going downwards. So again, you can profit from the market whether it goes up or whether it goes down. Now, here are some option trading examples. So when investing in options, I want you guys to focus on these main three things. That is the stock price, which is called the underlying. And so stock, underlying, they're the same thing. And there's a strike price and the expiration date. So let's do a call option example. And for this presentation, we're only going to discuss how to buy call options. We're not going to go into put options or how to even write your own call options. So just call options for now. All right. So this is Leon's Diner. His particular diner has a stock price of $60. So currently he's trading at $60 in the market. So it's trading at $6 in the market, but if you want to buy the shares, it's $60 per share. Now, this is Esther. She owns 100 shares of Leon's Diner. All right. So that means that she has $6,000 worth of shares. So that's 660 times 100, which is 6,000. So it's $60 per share. Well, good. This is Joshua. Now he wants to buy 100 shares of Leon's Diner, but he's frugal. He doesn't want to pay $6,000. Why would we going to do that? It's too expensive. This is where an option contract comes into play. Now you heard the example that I gave before. So of course, option contracts give you the ability to buy, let's say, 100 shares for a much cheaper price. Now, this option contract gives Joshua the ability to buy 100 shares of Leon Snyder at an agreed upon price, which is called the strike price. For this example, we're going to make the strike price $60. So, again, this strike price is the same price as the underlying. But let's say the strike price can be $65. It could be $70. It could be $80. So pretty much, actually, I don't say that a little bit, but let's continue. So there also needs to be an expiration date. So let's make the expiration date for this example 3 weeks. Now, expiration date can be 3 weeks from now, 4 weeks, 2 years from now. So it's up to you. Now, I'll let you know that if the expiration is longer, it has more time value, which I will explain. I'll give you a brief, I'll give you a synopsis of what I'm talking about. So when an expiration date has a longer period, it has no time value. So that means that option is going to be a lot more expensive. But if it has a shorter time value, it's less expensive. So this means that Joshua believes the stock will move past $60 before or past the expiration date. Are you guys following? Awesome. So the payment for this option is called the premium. The cost of the premium is determined by the stock price, expiration date, and implied volatility. The implied volatility is the likeliness of the stock moving past the strike price before the expiration date. So for this example, let's make the premium $6 per share. So since one contract is 100 shares and the premium is $6 per share, the total premium is $600. Sounds good? Now the premium is given to the seller of the option contract. Now let's see what happens. So within the 3 week span, that $60 went to $70. That means Leon's Diner, his stock rose from $60 to $70. As we can see, that is a $10 increase. So let's see what happens to the option. So Joshua previously purchased one contract for $600. That contract is equal to 100 shares. Since Leon's Diner, since the stock moved past $60 to $70, his option contract has increased $10 per share. Basically, that is $10 times 100, which is $1,000. He made a $1,000 profit, not including commission fees. So when you trade on a platform, there's always going to be commission fees. Let's say you made a $1,000, it may say you got like $999 or $998. So depending on which brokerage form you're using, the commission fee varies. So every $1 strike price translates to $100 profit. That means your trade is in the money. That also means this option has intrinsic value, which is the stock price minus the strike price. So whenever the stock price moves past the strike price, you just subtract the stock price from the strike price, and that will tell you how much intrinsic value that the option has. Okay, that's all. Now, let's say your call option is on the last day before expiring, and the stock is traded at $65 per share. Yes, your trade is technically in the money, but you won't see a profit because of time decay. This time value is called extrinsic value. Basically, it is the cost of the premium minus the intrinsic value. So pretty much, when you buy a stock and it has, like, let's say, a 3 week expiration date, you have time value. As the time goes on, which I'll say in a minute, as the time goes on, the option loses value every single day. Because in its mind, the option has no faith. It's basically saying, you're not going to reach your goal before the expiration. So it decides to drop the value, or it's not interested in the option. So the only way to increase extrinsic value is for the stock to increase in volatility, which in this case is how high the stock goes up each trading. So there are some stocks, let's say GameStop, for instance, is trading at $30, and we're at $31. The way the time decay is going to play on that, saying, it's not going to reach its goal by the time expiration day happens because it's only going up by $1 or $2. Versus, let's say GameStop goes from $30 to $50, and it fluctuates between like $20 each day. That lets us know that this particular stock has something going on. I think that it is going before the expiration date. So basically, the more time your option has, the more valuable it is. For your trade to be profitable on expiration, you have to move past the break-even point. So the example I gave before is that let's say that particular option was trading like before the 3 weeks, even before the end of 3 weeks, it reached its goal. You don't have to really worry about the time decay as much because it already hit its goal. But let's say on the last trading day, so the strike price is $60. If it's $65, it's $5 in the money. So what's going on? And the fact of the matter is that intrinsic value and extrinsic value play on each other. So let's say there's no more extrinsic value, the intrinsic value has to compensate. That pretty much, I'm going to explain that in a minute. So for your trade to be profitable on expiration, you have to move past the break-even point. Basically, add the strike price, which is $60. So add the strike price, which is $60, to the cost of the premium per share, which is $6, and you get $66. So technically, that $66 is the new strike price. So on the expiration date, the closer it is to the time value, the more the strike price increases to, again, that intrinsic value is to compensate. So intrinsic value is when the stock goes past the initial strike price, right? Extrinsic value is the value of the stock pretty much when you buy it, or let's say it's starting to go up, but it didn't hit the strike price yet. So the amount that you bought it on, pretty much that's the value of that particular option until it passes that strike price, which now has intrinsic value to play on the extrinsic value, if that makes sense. So I'm gonna answer your question.
If you buy an option for 3 weeks,
Yes.
and give the strike price within a week, can you sell it?
Yes. Because it already now.
Sell it and close everything out.
Yeah, so when you're making option trades, it's the best thing for you to do is to have an extrinsic and intrinsic value. So the most part is that when it has intrinsic value, we're trying to capture most of the extrinsic value. So pretty much we're trying to capture the amount that you pay for it plus anything past that. But the thing about it is that as the day gets close to the expiration date, your initial cost or your initial premium starts to decrease, and now your strike price has to be more impressive. So instead of $60 in this case, you have to go past $66 to even see some sort of a profit. Now, my thing is that if you're trading, let's say you're trading between like $65, you won't lose all of your investment, but you only lose some of it. If you're trading less than $60, your option is worthless and you lose your whole entire investment. So pretty much you lose all of your $600 that you initially invested into the option. All right, I want to make sure we all get it because some of us look a little confused. Right, so what part are you guys confused on here? If you guys even want to, okay. Go ahead, baby.
How do you determine how valuable the stock is to the market? And if it's say oil.
Oil, okay. That's a good one. Because oil is booming right now.
Yeah. So how do you determine, if you're investing, how do you determine how valuable that stock is?
Well, yeah, the market determines how valuable the stock is. Now, you mean in correlation to trading options? Or just how do you determine how valuable it is in general?
And trading options.
So in trading options, or when you go on the platform, you pretty much set the price. So it's between you and the person selling you the shares. So depending on where you invest, like again, it's best not to even invest in options that are going to expire within a day. You can. I traded options like that, but I day traded it, and I won't discuss that right now. But if you want to buy an option, you want to make sure it has some sort of intrinsic value. I mean, at least give it a week, not something that you're trading a day because you have a high chance of losing your investment. So between that point, between like, so if you're going to buy an oil option, I don't even trade in oil. I can't give you the best example, but so let's say even like you're trying to buy an oil option and you buy it for, one contract was 100 shares, you pay $500. And your time limit is 3 weeks, and you want it to go past, and the strike price is $50. So within that 3 weeks, it's best for in that first week for it to go past $50 for you to see a profit. So pretty much that the value of that option is based on the extrinsic value until it passes the intrinsic value. If that makes sense. I'll get back to you, baby. I'll get back to you. I'm sorry,
I
Minister.
think I understand where her question is kind of coming from. She's trying to find out how do you keep in the know of the value, and I think it's about watching it.
Mm.
You have to keep your eye on it. Is that correct? So that's how you find out the value of the facility. You're keeping your eye on it, you're not taking your eye off of the stock that you.
Oh, do you mean how you know if that particular stock is going to increase?
Yeah.
Oh yeah, you just have to watch it.
You're watching.
You have to watch it, yeah. So you have to watch the stock. So it's best not to invest in any stock without at least having some understanding of it. So when I invest in stock, I invest in a lot of tech stocks. That's very risky. I trade tech, options of tech stocks. So that's very risky, but I make sure I watch it every single day because all it takes, like for right now, we have the treasury yield that pretty much shot all the tech stocks to the bottom. So that's a great time to invest in put options. But let's say you have a long call option, you're gonna start losing money because you didn't know what was going on. Because one thing about call options is that you cannot sell it during after hours or pre-market hours like you can sell stocks. You can sell stocks in after hours or pre-market hours, but when it comes to options in particular, you have to sell them during the trading day. So the stock could be doing whatever it's doing early in the morning, and then you find out, oh man, my stock went down because of treasury yields. So there's certain news like that can affect the stock market, especially when it comes to technology stocks, because technology is never leaving. Yes.
So call options sound.
Yes.
The call options is based on your investment tolerance, and so that sounds like it's for more someone that's kind of a risk taker.
Mm.
Would you agree with that? The call options are someone that's more risky than.
I would
Tell
say trading
Katie to
options in
turn off the
general is
mic,
riskier
please.
than trading stocks. So yeah, if you trade options, it's a lot riskier. Now, of course, there are ways for you to limit your loss, which I'm not even going to discuss, in this presentation because it's going to take some time. But yeah, there's a thing that's called a stop loss. Let's say if you invest in, let's say GameStop, the strike price $30, you would buy one share with one contract was 100 shares, and your premium is, let's say, $100 for one contract. You can literally put a 10% stop loss under there. So that means it will sell when it hits 10% below. So that'll be like what, $80. If it goes, that would be $90. If it goes 20% below, that'll be $80. So at least you can stop it, and close it out there. So you'll lose 20% of your 20% of your investment, but hey, it's better than losing the whole thing. Yeah. Any more questions? Okay, Sam.
Okay, so how important, or maybe on a scale of 1 to 10, how important do you think it is to pay attention to the news surrounding the industry that you like to invest in the most?
Very important.
It's very important. It's very important. I would say that the news that you see doesn't translate to the next stock, market day.
Mm-hmm.
So let's say you hear some news this day, it may not affect the market tomorrow. Most of the time it does from what I've seen. But sometimes that particular news can affect the stock market next week. Like the treasury yields, that's like the Fed reports. That stuff has been making the stock market, it ruins all of your analysis. One thing is that there's analysis trading that, you can trade based on, this is how the stock performs each month of the year. But then all it takes is for, COVID-19 stock just goes, it can either go down. So mostly tech stocks usually go down with news like that. And then you have like stores like Walgreens or these retail stores that actually increase in price. So you got to know which prices increase at the particular time. So for instance, like retail stores, they profited over COVID-19. A tech stock like Fiverr, it increased because that's a platform that allows you to operate your business from the home.
Zoom.
So yeah, Zoom, that stuff, Zoom reached a whole other level in 2020. It hasn't reached that level, it's been downward since then, but Zoom reached a whole level in 2020 because of COVID-19. So depending on your stock, or depending on the particular stock, you can profit. So with certain tech stocks, the news can affect it. Well, let's say with certain, so with tech stocks, all it takes is for the treasury yield to ruin that, and it'll make bank stocks go up. So certain stocks will profit on certain days, and other stocks will not. That's what I'm trying to say. Yes, full bank.
Yeah, if you buy a call option,
Yes.
who is the individual? Is it an individual or like a broker issuing you the option? And
There's
do they
always-
have to? Do they have to actually own it, like in their name?
Well, yeah, there's always a brokerage facilitating who's trading the options. But everything goes to a brokerage. But let's say, for instance, you can literally write a contract and give somebody those shares. So the shares can either be sold to you by a firm or an individual. Now, the thing about it is that there's things called covered calls, which that's a whole different thing. I wasn't able to discuss it here, but since you asked, I'm going to give you a brief example of it. So there's things called covered calls, which that means if you sell the option to an individual, to a buyer, you have those options. You have those stocks on those shares on standby. So that means you own those shares. There's a thing called a naked call, which means you're writing an option, but you don't actually own those shares. So that means you're open to unlimited risk because let's say that particular buyer, if that particular option he profits from that option, and he chooses to exercise that stock, it'll force you to have to go buy the stock, and if you don't have money, now you're in debt.
You're naked.
Yeah.
Didn't that happen with? I thought that I read that happened with Tesla stock, and the brokerages lost like $8 billion.
I heard about that.
Was that
I didn't read too much into
naked?
it.
Yeah, I think that was naked.
Naked.
Let's just say, to be truthful, there's most brokerages right now that they won't even let you do that if you don't have money on the side. It's just not. It's dumb. I mean, I would never sell an option, or I would never write an option contract if I don't have the shares. If I don't own the shares, because anything can happen. To be truthful, writing an option, yes, you can. Technically, you profit, but you're literally set yourself up for unlimited risk. It's very risky because you can lose more than the premium. Because once you buy that, once the person buys your option, you get the premium. But then let's say that stock is going in their favor, you can lose the premium and much more. So let's say a premium is $600 and the stock is, you're predicting that the stock, you sold a call option for thinking that, okay, that stock option is not going to go up. They think it's going to go up, but you think it's not going to go up, it's going to stay the same, and it's going to expire worthless and I get to keep the premium. But let's say that GameStop option skyrockets to $10, right? Okay, they lose some of that premium. Let's say it goes to $20, $30, $40. They can lose that $600 premium that you initially paid for, and then some. So that means they can be, let's say GameStop skyrockets like it did to $300. They can be like $20,000 in debt. So they can minus that $600 premium. So yeah, if you're writing calls, yes, you can profit, but you have to know how to, have risk management. Even when you're buying options, you need risk management. This stuff is very risky. I know firsthand. I've traded in the market, lost money before. It's not fun. It's not fun. So yes, you can make a huge increase. You can make a huge profit trading options. I've made money, good money in the market, but I've also lost good money in the market. So you have to understand your risk tolerance. And for you to be a winner in option trading, the best thing you can do is know how to have risk tolerance. Know when to put that stop loss there. Even if that market goes downward and it sells and it skyrockets up, at least you know you kept most of your investment. So you can trade another day. All right. You live to trade another day. So yeah, and we have part 2 coming soon. So, do you have any questions? Yes.
I have a question about, a split,
Yeah, I was gonna ask that.
split, when a company splits, do you know about that?
Oh,
Cause
when the stock price split like a 4-to-1.
Yeah,
a
so
4-to-4
I
stock split?
bought some GE about a month ago,
Oh,
and
sweet.
it was down, no, it was down, I can't remember how much I bought it for, but then it split. The next thing I know, I had the money that I, with the shares, they gave it back to me, and now the stock went up from, say, like $17 to $100. But the split caused them, I didn't have my shares anymore, they just gave me my money back, so I was wondering, do you know anything more about, or how to explain this, but it didn't understand how that worked.
Okay, all right, that's good.
When the stock split, right?
Mhm.
Let's say you buy it for $200,
Mhm.
okay, and then it goes to the split to 1 to 4. You can split one share to 4.
Okay.
So now instead of $100, now okay, let me explain. The person who is already in, who already have his share,
Mhm.
okay. Now instead of you having 1 share now you have 4.
Gotcha.
You have 4, you understand?
Mhm.
But the value of each one is going to be like 25, 25, 25, 25.
Mhm.
Okay? You got it?
Mhm.
So you have 1 before, now you split 1 to 4,
Yeah.
now you have 4 shares,
Mhm.
but it's still $100, but each one is $25 each.
Mhm.
Now the person that is coming in that you just buy for the first time,
Mhm.
when
Got
they
it,
buy, when they have to buy 4, they have to buy 4 to have your amount of one that you have. You get it?
A little.
Okay.
So, yeah, I would say pretty much if you already own it, then your stocks pretty much increase.
The increase. Now you have, instead of having 1, now you have 4.
Got you.
But the person that is just coming in have to buy 4
Okay.
for your 1.
I got you, but they gave me my money back. That's what I.
No, that's wrong.
So that's strange. I've never,
No, your
that
money
never
is supposed to increase.
They gave me the G put my money back in my account, and instead of the share being like $20, they said it was $20, and now it's worth $100. But they put my value of my money back into my account, so I don't.
So,
know.
but you still have your share, right?
No,
I bought it back.
I don't have my
Or something like
yeah,
that.
that's strange.
That means you sold your stock to somebody. Your share to somebody. That's wrong.
What platform, what brokerage firm are you using?
Robinhood.
Man,
Or something.
Take from the rich and give it to the poor.
Like $400 and stuff.
Robinhood. Yeah, so Robinhood,
No, that's just another. That's just a platform
it's
that
a
I use.
platform. I'm not a big fan of Robinhood because there's been some issues with Robinhood. Yeah, I'm not gonna go too much detail, but I don't use Robinhood. I would just use if you have Bank of America, that's called Merrill Edge.
I got Merrill. I do have
Merrill
I
Edge
use
is a
them too.
great platform to use
That's what my
because they
phone
even give you option they do their own analysis. They give you option trades that you can just execute, and you have a chance of making money on that right off the bat. Also, TD Ameritrade, I like the educational tools that you can use there. And by the way, if anybody wants to learn how to do option trading, you can just go to my or email me at joshua.peter.stocktrades@gmail.com, and I'll give you information on certain things you can study up on how to learn about option trades, understanding premium with most of the terminology if you are trading options, and also brokerage firms you can use to invest in options. So my Gmail is joshua.peter@stocktrades@gmail.com.
Just okay, this one to the
All right, my Gmail is joshua.peter.stocktrades@gmail.com.
Okay, not just for the benefit of the people that are listening, so they can know what you are doing.
Mhm.
How much what's the largest amount of money you made in a day?
In a day.
Yeah.
Well, that depends on what you call it. Yeah. So the largest amount that I've made personally, I made 65 grand in a day. And then sometimes in a week I made 100 grand. So, but on a bad day it's 10 grand a week. Or on a bad week it's 10 grand a week.
And this is from option for you.
This is from option trading, but you got to pay attention to it. Like
So that's a whole nother thing from just regular regular trade, because you're keeping your eye on the system all day. That's your job. You're watching what's happening.
Now, sometimes I swing trade, sometimes I can leave it there. I watch it every single day because you never know what can happen. But there's, types of trading that's day trading, so you can trade within a day and sell it off. Like, sometimes that $6,500 I made that in 2 hours.
Yeah.
And then I called it a day.
Mhm.
So, but that's sometimes I took me to watch that market for like a week or two just to get that particular trade that I was able to make that profit. And I was able at one time to turn $1 grand to 100,000 grand in 3 weeks. So, yeah, it's profitable. But then again, I've lost a lot of money before too. So it took trial and error. So sometimes you may make hey. What I want everybody to focus on is that no matter how much you make, at least you're making something every single day. $10 a day, hey, that's $10 you didn't have before. $20 a day. I mean, if you get into trading options, you can literally learn how to make $100 a day. It's very much simple, but I want everybody to focus on risk tolerance. Some people don't have the stomach for this, and sometimes, and again, I'm going to tell you from my own experience. Sometimes the market looks too good, I can make more, and all of a sudden the market just goes downwards and you end up losing your gain and then also some of your capital. So pretty much what I want everybody to focus on is risk tolerance, understand how to preserve your initial investment. My thing is that you always, for the most part, try to be trading on top of your gain, not always using your capital. So my thing is when you make money, try to trade on your gain. Don't invest too much. If you want to trade your capital, you can, but don't invest too much of it. Because you always want to have your capital on a rainy day. Any more questions? Yes, next.
So, would you ever start a TikTok page talking about this that would teach people, how to do this?
I don't even consider myself a guru, honestly. I'm still learning. There's still things that I'm learning myself. I took simple concepts and turned it and made it profitable. But there's still things that I'm learning every single day. Like even me, I started going through option trading just for this teaching, like learning more about it, not just some stuff that I saw, like, well, I didn't see that before. I can use that in my option trading. So it's a lifelong thing. You're going to be learning new things every single day, but you can turn the simplest concepts or understand the simplest concepts and make a profit from it. So it doesn't take you learning everything all in one day or even in a week for you to be able to trade options. Stop.
What are the indicators you look for before looking at an option or stock?
Indicators. Wow. Okay, so a lot of this stuff is supposed to be in a later presentation because there I have a platform that I use. I use Thinkorswim, and it's pretty much it shows you the graphs for each particular stock. And I have pretty much my own settings, like the Bollinger Bands, which pretty much it's like a 3-string band with 3 different colors, and it lets you know the highs, the medium, the lows of this particular stock. So if I want to day trade something, I know, okay, this is the highest point that it may reach within, let's say, a 50-week period or 52-week period. So it takes a lot. It's hard to explain right here. I have to actually show you the platform, but yeah, I use certain indicators, certain systems to predict the outcome of the stock. Yes.
Why does certain parts of the stock market fluctuate when there's like a natural disaster or like a major significant political or crisis in the world somewhere?
You just answered it. When people get spooked way too easily. That's the one thing that annoys me about trading options is that people bail out way too quickly. And let's not be fooled. I'm pretty sure there's a lot of corruption even in the stock market. There are people who, some of this news benefits other individuals. So one thing about the stock market is that don't try to beat up the stock market. You're never going to beat up the stock market. Always try to ride the wave. So yes, when you see stuff like the annual treasury yields, which happens I think every September, like literally September is historically known for being the worst month to trade in general. I mean, I would say get money to trade bears, in September, but for the most part, it's the worst time to trade in general. So, but then stuff like the pandemic, that stuff has affected the stock market. You hear Fed reports, which we've been hearing that for the past few weeks, that affected the stock market. So yeah, all these news, if like these Fed people say something, people listen. If they say, "Oh, inflation is rising," stuff is going to happen, people are going to bail out so fast. Like you may have risk tolerance, but other people who are like, you gotta think about it. You're most likely only investing a few thousand. Some people are investing millions. So they're going to bail out whenever they hear bad news. So you just have to be prepared for that. Like I said, risk assessment. You know, don't trade something you're not afraid to lose. Yeah. So I invested money that, you know, I was actually afraid to lose, but I didn't know that was going to happen, and I'm losing a good portion of my investment. So I've learned now, trade and have multiple. Don't put all your eggs in one basket. Even when the Bible says that, don't put all your eggs in one basket. Trade in different options. Trade a little bit in different options, and then allow them to grow one by one. But don't put all your money into one particular option, because yeah, you can make a profit, maybe a huge profit. But at the same time, let's say if it goes the opposite way, you can have a huge loss. Hey, go.
Yeah. That's what I want to ask you. Do you buy and hold?
Options
Um,
or stocks?
Period.
I mean, I make money from options. I don't need to buy
Okay.
stocks.
And the reason why I asked that is because I was taught or told that you should be buying stocks for the rest of your life. This is something that you do. But I'm more interested in stocks that provide dividends. You are into I know about stocks that provide dividends.
I won't talk about something I really don't know, but eventually I'm going to be trading when I have enough. When I have, well, I'm going to be having stocks I'm going to hold for a long period of time. So eventually I'm going to do that. Right now, I'm just focused on trading options, learning more about option trading. Yes.
The company we used to work with, actually we still work with them. They said we should have at least 25 stocks to hold on to for investment, long-term investment.
Yep.
At least minimum of 25. Yeah, so you buy it and keep it, leave it there.
And just keep
Don't
feeding.
even check it, just
Right.
leave it there. You know? Yeah.
But make sure you have stocks that have dividends, stocks that you know is going to be profitable, over the course of the year. So it can be retirement stocks.
Exactly.
You know, you don't want to get like penny stocks are usually the worst things to invest in because yeah, they're cheap, but then they may just crash or they may not go anywhere. So a lot of people have lost a whole bunch of money because of investing in cheap stocks. So usually the stocks that have more growth potential, like I would say Apple is a good long-term stock. Microsoft is a good long-term stock. Amazon, yeah, but Amazon's $3,000 something per share.
That's a lot. It's expensive.
Depending on the money that you have, it may not be that lucrative. I mean, it's lucrative, but you gotta be able to invest in at the moment. Hopefully, you guys will have that much money to invest in, stock in Amazon. That's my goal as well.
First of all stocks can provide dividends. So,
You want to explain dividends?
let's play portfolio. Go back and forth. You look for quick return.
Yeah, most stocks give you very long-term dividends. That's correct. But yeah, if you're looking for a quick return, I mean, yeah, you can hold day trade stocks sometimes. But I feel like options are a lot more lucrative, so you'll be able to have a better profit than just trading stocks. Because usually people who are day trading stocks have a huge capital. But people who don't have a huge capital, they can at least increase their portfolio by trading options. So, and since I, need a good amount of money trading options, I don't see the point of you trying to day trade stocks, trying to day trade options for people price. Yes.
Do you know anything about NFTs?
It's an ETF, that's all good. ETFs are also a good thing to trade. So ETFs are pretty much, like when you see like SPY, that's the S&P 500. So ETFs are pretty much watching these major stocks like the S&P 500, Dow Jones, Nasdaq. So they're also good, cheaper or good trading investments. So I feel like they're also long-term trading investments if you want to get into that.
How do you feel about cryptocurrency?
Because that's something that I am also trading as well. That's a whole new ballgame when the Ruben goes by as well. He's investing in cryptocurrency. But that's something I have to do more research on. I am invested, but I didn't put too much money into it because, I think it's the future. But right now, I don't know where it's going to go because it seems that you know, these bad news also affects, you know, cryptocurrency. And right now I'm betting on Ethereum. Yeah. Cryptocurrency.
Did you say crypto?
So you can want that to invest for a year or 2 years.
Honestly, I like cryptocurrency because you trade every single day. And Michael, you can day trade cryptocurrency if you want to. So let's say Ethereum right now is at, I'm not even sure, I think it's at 2,800 or something right now. So let's say you have a good capital. So that's 2,800 for one Ethereum. You can literally, let's say you have 10 grand, invest into Ethereum, probably get like what, 5 or 6 contracts, I'm not even calculating out, but it's roughly saying, let's say 5, 6 contracts, maybe even 4. And then with that particular, with those 4 shares, crypto can go to $100 within a few days, if not a week. So that's gonna be 100 times 4 shares, which is $400. And if you choose to sell right there, you're in a $400 profit. So if you want to do that as well, I like options. But cryptocurrency, I do see a future with them. But right now, you know, we need to test the waters because I feel like there's a lot of gray areas when it comes to cryptocurrency. Bitcoin and Ethereum are one of the top ones, and they're the most expensive, one of the most expensive ones. So there are some cheaper ones as well, but some of those cheaper ones, I don't know where they're gonna go. Again, I'm not a guru of cryptocurrency. I don't even consider myself a guru in options trading. I'm still learning, but I'm just saying I profit from trading options, and I also make a profit from trading cryptocurrency.
I'm with that, because I know something too. So I give you my, because I'm going to do, I'm going to do and I took my money.
I get pressure at home.
You know you got some luck.
She comes to me and says, how's business?
You know, I did when I double it. Hey, come on now, you did double it. I said, give my money.
So do you have any more questions? Alright, awesome. So I didn't even open this up in prayer, so I apologize. Father God, I'm going to close it out in prayer. So Father God, I just thank you for using me to teach your people about investing and how to invest in options. Father God, I pray that you give me the wisdom to be able to explain myself or to get the message across better, Father, to help me to get my next teacher to get a shot to teach people how to invest in money and how to bring practicality to their financial education. So Father God, I just thank you for this. I thank you for using me to teach your people and we give praise to the Lord in Jesus' name. Amen. If you guys still have questions, you can. Yeah.
So, does it make sense to, if you have a family or multiple people, if you bring your capital together to invest it together so you can, as a group or family, make real money?
Good, because if you lose the money, how we deal with that?
They're going to be a worse enemy.
There's some people, there's some different in my language. People who go through it, money, relationship, because you know, we trust you that you money. So to put money together with family members, you got to be somebody you trust and you have to
I understand, but
have
I'm
risk
saying,
tolerance.
yes,
I would say probably the best bet is immediate family. I wouldn't even
what's going on behind it, but that would provide you more capital to do more stuff, you know what I mean?
I agree, and I guess me personally, to be able to trade with people is to be able to trade for